Hi everyone, this is a technical analysis on the USDJPY pair. Let's start with some fundamental background first. In the US, the Fed left interest rates unchanged as expected at the last meeting. The macroeconomic projections were revised higher, and the dot plot showed that the FOMC still expects another rate hike by the end of the year, with less rate cuts projected in 2024. Fed Powell reaffirmed their data dependency, but added that they will proceed carefully. The recent US CPI data beat expectations on the headline figures, but the core measures came in line with forecasts and the market's pricing barely changed. The labor market remains pretty resilient, but there are some signs of softness, as seen yesterday with another miss in continuing claims. The US retail sales last week beat expectations by a big margin with positive revisions to the prior figures, suggesting the consumer spending is still solid. The US PMIs this week showed that the economy now looks more balanced and resilient. Fed Chair Powell and other FOMC members continue to highlight the rise in long term yields as doing the job for the Fed, and therefore they are expected to keep rates steady in November as well. In fact, the market doesn't expect the Fed to hike anymore. In Japan, the BOJ kept everything unchanged as expected at the last meeting. The Japanese CPI last week showed that inflationary pressures remain high, with the core reading hovering at the cycle highs. The unemployment rate last month remained unchanged near cycle lows. The Japanese manufacturing PMI matched the prior reading, remaining in contraction, with the services PMI falling but holding on in expansion. The BOJ officials continue to repeat that the central bank should keep the current monetary policy. The latest Japanese wage data missed expectations again, which is unlikely to lead to a more hawkish BOJ in the near future. Today, the Tokyo CPI, which is seen as a leading indicator for national CPI, beat expectations across the board. Now, on the daily chart, we can see that the USD/JPY pair managed to breach the key 150 level and stay above it without any intervention. The buyers might start to have a bit more confidence now to push the pair into new highs, although we continue to have some notable bearish signs. In fact, we can see that the divergence with the MACD is getting bigger and bigger, and it generally takes just one meaningful fundamental catalyst to change the entire trend. So this is a big risk to watch out for. On the 4-hour chart, we can see that the resistance has now become support, and we can also find the conflicts with the Fibonacci retracement levels and the red 21 moving average. This is where the buyers should step in, positioning for new highs and target the 152 level. The sellers, on the other hand, will want to see the price falling back below the support and the trend line to invalidate the bullish setup and position for a drop back to the 147.82 level. On the 1-hour chart, we can see that we had a spike yesterday here for no apparent reason. It doesn't look like an intervention though, given that it's too little. The buyers are likely to increase the bullish bets if the price breaks above this counter trend line and keep targeting the 152 level. From a fundamental perspective, the recent drop in treasury yields, the signs of softness in the US labor market, and the beat in the Tokyo inflation data might give the sellers enough confidence to push the pair lower. But we will first need the price to fall back below the 150 level. Today, we will get the USPC report, which is unlikely to change anything for the Fed at this point in time.